You're not mic'd. Here you go. Okay.
Well,
Take your seat.
we'll try the audio version of this. There we go. Okay, can you hear me now? All right. Good morning again. All right. Let's start off with the first slide. We'll just keep rolling along. Oh, hold it. I'm the one who can control this, right? There we go. Okay, for those of you that want to go to sleep as usual, here's the summary of everything. And as I pointed out before, if you have any questions or you didn't hear me, raise your hand and I'll try to answer it immediately or postpone it till I figure out a good answer to the question. All right. Our overview is that the economy is strong. We're going to have 3% growth in 2018 and a slight moderation in 2019. A look at the components is very good for transportation and freight near term. However, this better than trend activity is really not something that will continue ad infinitum, but in 2020, 21, and so forth, we think that we're going to go back towards the longer term trend of around 2% as the forward push or the impetus of the tax cuts and the tailwinds that we've been running with moderate as we come along. The unemployment rate is super. Currently, it's 3.9%. By the end of 2018, it will be down to 3.6%. And further down to almost an unprecedented 3.3% at the end of 2019. While the possibility of a recession has increased somewhat, the overall probability is still very low. But at the same time, we think there may be pockets of weakness, particularly in retail and manufacturing, and what we call rolling recessions as opposed to an overall recession for the economy. On the inflation side, we think around the 2% or so is going to be the trend. The core rate, ignoring the volatility, is going to be just slightly above that for a while, but then because of technical factors, it's going to move back down towards the 2% area. In terms of the components, services will keep running around 3% or so in the United States as measured by the CPI, but that will be moderated to some extent by increases in commodities, but at a lower rate, giving us an overall trend of about 2% or so. Interest rates, we think that policy is going to be data-driven, meaning if we have very, very economic news, the Fed might stop raising rates or even, heaven forbid, lower interest rates. On the other hand, it's going to be a well-advertised move. It's going to be moderate and measured as it comes along, despite the tweets that you may have heard or read about this morning. The federal funds rate, we think, is going to be ending the year around 2.5%. And by the end of 2019, it'll be around 3.25% and so forth and so on. Just to note, 3.5% or 3.25% on the Fed funds rate in 2019 should be high enough to begin having a bit of a bite on the growth rate or the advancement of the economy. Or to put it differently, the Fed's claim that it's been accommodative will probably be erased. Okay, now for the details, as they say. Here we go. Here's the picture of the economy. The standard measurements on the right and the left axes are growth in percentage terms. The blue lines are past history. On the right, you'll see the top green line is the optimistic view as measured by the blue chips consensus. The green line is the more pessimistic, and the dashed red line is ours over there. What's motivating economic activity is strength in consumption and business investment. The big the question mark or the big weakness is going to be the trade deficit. As you can see, we're closer to the optimistic side as compared to the overall consensus through 2019. After that, we think that the impact, as I said earlier, about the tax cut and things like that will begin to wane, and we see the growth rate moving towards the 2% or maybe lower than that, depending on what policies that we have. Just bring something closer to home. This is a look at sectors of the economy as measured by employment. And the key things in here to take a look at, the dotted line is the growth rate of employment in the whole economy. And as you can see, we've gone from 2015 at about a 2% per annum growth rate of overall employment to something closer to 1.5% recently. Now, digging a little bit deeper, the green line shows you the growth rate of those sectors of the economy that we labeled goods-related and much more closely related to our overall activity, and that consists of manufacturing employment, construction, and things of that sort. You can see that 2015 to 2016, it had weakened, and then we kind of have gone off to the races, fairly strong activity overall. Black line kind of parallel to it, but a slightly lower pace is manufacturing, and we all know the story behind all of that stuff. The red line shows you the growth rate of employment in the trucking industry, and I think the three takeaways are, number one, growth has been expanding in that sector in line with, as you would expect, with manufacturing and goods producing overall. The second point is that the growth rate there is smaller than or slower than what we've seen in the other two. And as I think Kenny will point out later on, what this means is, as Kenny will point out, the growth rate of freight and so forth has tracked the growth of the economy. And so the net explanation for this is to get transportation to work, we will need some significant increases in productivity to be able to move all that freight that we've had before. Okay, just to round it out, here's our forecast for industrial production. As you can see, it's been accelerating in the most recent time period. As we come to the box is our forecast, and it's moved up a lot, because of the growth in manufacturing that we've all seen, and also industrial production has utility output, which has jumped up also. We expect those to moderate in 2019, or the second half of this year in 2019, back to a trend rate below 2%, which is below the longer term historical thing, but still positive, but a bit slower than what we had before. All right, the trade barrier stuff we can talk about quite a lot, but just basic questions are, is the policy that the administration right now moving, an example of them having religion and they want to kind of change the playing field, or is this more of a negotiating ploy and it moves along, and the implications will be, if it is more of a ploy than religion, what will be the effective events later on are going to be different than what's pronounced in the beginning, and we have to see how it works out. The next one is the various effects on all of this stuff. You can read them on your own. Let me just add one more variable to here. Sometimes with the obvious thing that you leave out, the strength of the dollar is a very important element in all of this, or the strength or the lack of the dollars overall has an important effect on the impact of prices on inflation and activity in the United States, and that's one more variable to add to those over there. If you put it all together, our expectation is that we're likely to see the impact of what has occurred to date in the fourth quarter of this year and the first quarter of next year, specifically in terms of prices and economic activity. We think that overall, the inflation rate may be about 0.2 or 0.3% higher than our forecast would show. Number one, in terms of economic activity, it could reduce overall activity by about 0.2 or 0.3% also there. Two minor points which we economists love to point out is, number one, the rise in inflation, or let me do it the other way. Inflation, as economists view it, is not simply a price of chocolate going from $1 a bar to $2 a bar, but a continuous increase in prices. While imposition of tariffs may raise the prices, it's more of a change in the level rather than the rate of inflation. Or to put it differently, we'll have a little bit of an increase in inflation as the tariffs are imposed, but as time goes on, that effect disappears and we get more of a deceleration coming about. On the real side, the two sectors that are most vulnerable are manufacturing and retail, and in both of those cases, if we do have a weakness there, it's more limited to that area. Now, that doesn't mean that other sectors are not going to be impacted also, but there'll be second and third degree impacts, but overall it will create what I called earlier a rolling recession, but the risks of an out-and-out recession, while have been gone up somewhat, are still relatively low in our estimation. The most important part in here is that the uncertainty factor is very, very high, and that's always detrimental for planning and economic activity. All right, turning to inflation, here's my artwork on it. The red line shows you the headline CPI, and the green line shows you the core, eliminating it, and the dashed lines are the appropriate forecast. You can see that we expect the inflation rate as measured to go up in the first half of this year, but then to moderate for various technical reasons, and we'll kind of work around the 2% area. Clearly, we don't see a surge into 3%, a sustainable surge to 3% or anything of that sort. For the Federal Reserve, there are two things to do. One is the increases in prices relative to what we've seen in the past is one of the driving forces for raising interest rates from this accommodative posture that we've had to a more restrictive posture, but as I said before, data-driven, measured, and well advertised as it moves along. Because of the technicalities, the Fed is going to give almost a free pass for the high readings on inflation that we see right now, expecting them to come down. And obviously, if that doesn't occur, then the speed of increasing in interest rates by the Fed will come along. And as you can see, we look for stability in the 2019 area from the previous pace. Looking at a couple of different components of this, let me just switch here so I can look at it at the same time. I think we can kind of look at the energy market or the crude oil market somewhat very micro, or take a bit of a bigger picture on it. And I thought that we'd take a look at the big picture. 2016, all the numbers, by the way, are millions of barrels per day of crude oil produced. And you can see that between 2016 and the current time period, the growth per day of demand for energy has gone up. And we all know that in terms of the readings of a stronger US economy, a stronger world economy across the board. And it's estimated that the demand will rise by about 5 million barrels per day. The risk on that, and the arrow is pointing down, is that the growth will moderate from that strong pace of global growth, growing about 3.5% to almost 4%. And the headlines are just replete with things like that in terms of the European Union, China, whatever country you want to pick about. So the surprise there would be that demand will be lower than that 100. The implication of that, obviously, is that the pressures on the demand being lower reduces the pressure on prices. If we take a look at the non-OPEC supply, you can see that has moved up also about 5 million barrels a day. And there, the risk is for a greater than expected supply, not only from the United States, but from other oil-producing countries that are not members of OPEC. And the two major driving forces for that is, number one, the relatively high price of crude relative to the cost of acquiring it provides a profit incentive for producing more, number one. Number two, the spread of technology, the shale oil and whatever other particulars in that is spreading from the United States worldwide. So there the surprises are for greater supply, hence more of a downward pressure on prices between those two elements. The remainder, or if you prefer, the balancing fact coming from OPEC, requires them to produce about 32 million barrels a day to keep prices where they are. And below that are a couple of possible changes of the supply. Again, the column under 2019, the 3.4, 3.8, and 10.3 represents approximate production levels from these categories right now. And the column to the right of that shows you how it has fluctuated over the last couple of years. So as we know from the headlines, Venezuela is having a lot of financial problems. You will no longer be a millionaire buying a cup of coffee in Venezuela if the current devaluation is effected, which it will. But you can see there, Nigeria and Libya have had problems between fighting and all the rest that has hampered the production over there. You can see they're currently producing 3.4, which is pretty close to the lower end of what they have, but the potential for correction or stabilization is an increase in supply. Iran works the other way. The sanctions should be starting at the next month, and their production could be, if things work out, remain where it is now, but could drop as much as 1 million to 1.5 million barrels of oil, reducing the supply, and that would put upward pressure on prices because of the smaller supply available. Saudi Arabia has been claiming to be the swing element, but it really can't. If we have the worst situation, let's say the top line remains at 3.4, Iran drops down to 2.5 million barrels, Saudi Arabia on its own would not be able to compensate for all of that stuff, and so we would have upward pressure on prices if the sanctions do not really bite, or alternatively, if Nigeria and Libya are able to stabilize their domestic situation and increase output, that might offset the situation in Iran. So basically the story here is right now we're roughly in a stable situation vis-a-vis the price, and the surprise or the change in the future will critically depend on what happens to the sanctions versus Iran. All right, this is just the standard picture of the Federal Reserve moving along. You can all see that. We've talked about the situation. Technically, and let me emphasize this, that the Fed is on the process of raising interest rates in a moderate fashion. If the data changes, the Fed will change its opinion up and down. We're assuming we're going to get an increase in September and another one in December, unless, the sanctions really upset the economic apple cart. But, and our best guess is there. And then next year we get another 50 or 75 basis point move by the Fed, and raises us to that 3.25 range, which should begin to have some economic effects also. All right, this is just for your information where the interest rates are. We leave that for the others to discuss. The yield curve, we prefer looking at the 10 to 2-year spread. We're still slightly positive there, and we'll leave that for the others to discuss. I will take the privilege of talking about this on a very high level. Number one, recessions, in our opinion, do not occur by age, although in the 50s, 60s, and early 70s, it seemed like we had one every 5 to 7 years. Recessions or economies are not like dogs. They'll have different life. To us, a recession is caused either by a policy mistake, or the Federal Reserve says, I don't like inflation at this level, and I don't care what happens to you, we're getting that thing down, and they just drill the rate up until the economy says, ouch. Number two, there are different signals on it. It's important to say that the signals of the economy is the inverted yield curve. The fact that the yield curve is narrowing is simply a statement on the situation of the business cycle per se. And indeed, a lot of econometric models that try to use the yield curve to predict future economic activity really don't work in terms of that. Our forecast, as I said before, the probability of a recession is low but rising, but we don't think we're going to see one, certainly not in the next 2 years. Weakness in specific sectors that does not blow up over the whole economy is possible, though. And like all good things, I sit up at night and say, what am I missing? Here are a couple of interesting factors on this stuff. Number one, economists live and die by data, and sometimes we get some nice surprises. Before the GDP revisions came out on July 27th, people were worried about the savings rate as measured by the personal income numbers. As of May, the savings rate was around 3% or so. And there are problems in how that's measured, but everybody looks at it, so why not look at it? Well, when the GDP revisions came out, what we found out was the savings rate was not 3%, but closer to 7%. Here's the picture on it. The dark line is how we thought the saving rate behaved prior to the GDP revisions. The red line shows you where we are. And the presumption is the higher savings rate makes the balance sheet of households better. The potential for them spending has increased, and we can go all over these things. In case you say to yourself, what's 3% among friends? What really happened is the US accountants, particularly the IRS, found, now hold on to your hats or whatever it is that you usually hold on to when you get dramatic news, they found approximately 600 or 650 billion dollars that they didn't know was out there. And that's the revision. So one of the things that you always worry about is, do we live or die by what is being produced? So that's one thing to worry about. The second one is more esoteric, if you will. We all know that productivity has slowed down a lot. I've always been scratching my head, as most economists have, and often quote Kenneth Arrow's quote about productivity is all around except in the statistics. Roughly, that's what he said. And this is the same thing here. But there is a potential for productivity to increase in how we measure it, and in two ways. Part of the logic behind the tax cuts is that it will stimulate more investment in capital goods of various sorts and unleash animal spirits, which in turn might lead to a growth in productivity. And if that unlikely event were to occur, then many of the optimistic projections that have come out of the administration might prove to be true. But looking at the history and the demographics, that seems to be a long shot in itself, but it's possible. So if that happens, then the slowdown that I've told you is more likely to occur in 2020 and thereafter may not actually materialize. And just if you look at your handout, here's a picture of the history of productivity. On the left side is the longer-term trend, basically a 5-year trend. The red line is year-over-year movements. And for those of you who don't read graphs, the numbers are on the right side on that one. All right, those are the two good things. But as an economist, we always like to be pessimistic. Number one, it's little known, but there's a chance, and given the level of how governments are run, it's low probability, but needs to be underlined. There's a chance that the government will shut down at the end of September. We start a new fiscal year on October 1st, but the president or the administration has pointed out, unless the funding for the future has expenditures for the wall, he may veto the spending, and that raises the threat of a government shutdown. I mean, I can't imagine somebody doing that, but then again, I can't imagine a lot of things. Problems of contagion, the story with the lira and Turkey is the most recent headline, but this has been something that has worried me for quite a while, particularly in Europe with regard to Greece and Italy. A longer term and somewhat specialized esoteric thing is the leadership of the European Central Bank is going to change next year. The current leader of that, or chairman or whatever you want to call it, has the reputation of being more of a dove. An assessment of who will take his place may be less accommodative to that, and there's a fear that the rise in interest rates and a more restrictive European Central Bank will have implications all across the board. So that's something else to worry about. The geopolitical threats we all know about. And finally, always put in the rising debt that the United States has relative to GDP is always out there. Historically, we've kind of whistled past the graveyard and haven't worried about it. But every so often it starts coming back up to haunt us. A longer term, the implications of this is that we were going to have a reallocation of government spending, either reductions on mandatory spending, things like Social Security, pensions, and things like that, or a cutback in total spending, or some increases in taxes and revenues. As I said before, it's something that people worry about. It's a great conversation over beer, but rarely does it hit the fan to work us so long. So basically, what we are right now is in a world of good economic news on the real side, moderate news on inflation with some concern that might be a little bit higher than otherwise, and everybody worrying about when will the shoe drop, and is there a shoe to drop? Thank you very much, and Tim, back to you.